the stage Robinhood's Chief Brokerage Officer, Steve Quirk.
All right, hope everybody had a good break. Did you get some more coffee or whatever it is, the hydration, the non-alcoholic hydration that's sponsored, I told you about earlier. Glad to have you back. We got a good lineup here. Our next moderator needs little introduction. He and I have known each other for quite some time. He's the chief strategist at Optimize Advisors, veteran with 2 decades of trading experience, somebody you've probably seen on CNBC quite often. And when it comes to making really complex option strategies easy to understand, he's the master. So let's welcome up Michael Coe.
How are you all doing? All right, so we've got a great panel here for you. I'm going to just introduce them quickly, and we're going to get right into it. Before we do, though, I have a quick question, because I just want to get a sense, lay of the land. How many people here have not traded any futures at all before? OK. How many have dabbled a little bit, traded once or twice? And who's really active? OK, so that's the minority. So we'll make sure that we're going to try to have something for all of you. And to do that, and demonstrating the way that you can use this platform, we've got Adam Hickerson. He's the COO of Derivatives for Robinhood. We've got Bobby Iacchino, experienced futures trader. You may have seen him. He has a lot of stuff online with the podcast that he does with my good friend Jim Urio. Carly Garner. Carly Garner started a futures trading firm here in Las Vegas in the auspicious year of 2008. And she's still here to talk about it, which means that she probably has some pretty good experience. And then we've got Craig Bewick of CME Group, who's going to be able to talk a little bit about contracts and specifications and things like that. All right. So I think to get this started, why don't we just have a little bit of a primer here on futures. And I'm going to kick it off with you, Craig. OK. What are futures? Why do we care about them?
Yeah, that's a great place to start, because what I get surprised about sometimes when I come to events like this is that I'll meet very sophisticated individual traders who may be trading options on equities or equities themselves who don't know what a future is. And I've been in the business 30 years, so some things that are second nature to me aren't second nature to someone that hasn't been exposed to them. So I actually have this slide as my first one in my Futures 101 deck that I present a lot. And it's literally, what is a future? And a future is nothing more than a contract to buy or sell something, whether it's the S&P 500, the NASDAQ 100, an interest rate, gold, crude, any of these products that we list at CME at some point in the future. That's all it is. And in some ways, I think it's easier to contrast with what a future is not, because I think more people are familiar with the equity market, which conveys a right of ownership, right? If you buy a share of Apple, you own, albeit a small share of Apple, the company. If you buy a share of Robinhood, you own a little bit of Robinhood, the company. A future is simply just a contract, which makes it easier to sell that contract if you want. For example, if you want to get short a future, you simply sell it because it's just a contract. You don't have to borrow it and locate the stock and everything like that. Why should we care about it? Well, futures are what we call very capital efficient. So if you wanted exposure to, let's say, the NASDAQ 100, you can get a relatively lot of exposure to that index for a relatively small amount of money. In other words, that's leverage. And you know, we're very frank about what that really means. And with that comes the necessity that you're a good risk manager, a disciplined trader. But they're very capital efficient. And we think that whether you're a bank, a hedge fund, a central bank, we're all capital constrained at some point. They're open all night long, right? So you can get at your position, whether it's 3 in the morning Vegas time or 3 in the afternoon Vegas time, from Sunday night through Friday afternoon. And then there's some other benefits I think that we'll probably get into as we go along.
Yeah, that's great. I mean, and one of the things, just so you all know, we've got a live account over here, so we're gonna actually do some live futures trading here today to actually illustrate how you can come up with an idea, how you can affect that idea, how you can manage the risk in that idea. But before we get to that, Bobby, I just want to talk to you. He was just talking a little bit about some macroeconomic factors. One of the things that I think is kind of interesting about futures is that it encapsulate most of the macroeconomic world. Stocks can be very micro, but when we turn on the news in the morning, the things that we care about most, that they're always talking about, what's the Fed up to, what's going on, in the equity markets, what's going on with gold and crude. How do you think about this? How do you start your day, and what do you think about these as an instrument, because you've been active in this for a long time?
Yeah, I've been doing this for about, I think it's 32 years right now. I know I look great, but I'm older than I look. It's one of those things where early in my career, the first thing I looked at was the top 4 indices in the US in futures. I would look at the Dow, the S&P, the Russell, and the NASDAQ futures overnight. Because the liquidity in the futures has been great 24 hours a day before anything else went 24 hours a day. So that, was, to me, was one of the best indicators. It's still at the top of my watch list. It's the first thing I looked at. When you have big moves overnight in Japan, it affects the US. When you have big things happening in the EU, it affects the US. The macroeconomic outlook is shown to you first in the equity indexes on the future side. It's where the biggest traders in the world go. Any of you ever heard of Monroe Trout? Stan Druckenmiller? Paul Tudor Jones? I know Monroe Trout because a friend of mine that I went to high school with, he's in Market Wizards if you haven't read that yet. He was one of his CFAs that was in Bermuda with him. And I met him once when I went to visit him in Bermuda, and he said to me, "What do you trade?" I said, "Futures." He goes, "That's what the real traders trade." Now, I'm not saying that those of you that have not traded futures are not real traders. Far from it. But when you get involved in futures and you understand the minuscule amount of capital that you can use to trade a lot of the same things that you're trading in stocks, you almost think at your past life as a trader as having been not used in its best way, right? You can impart your opinion in markets based on some of the macros that you just mentioned, whether it's unemployment, whether it's the EIA report with crude oil. A lot of people, I used to watch you guys on CNBC, and the moderator would always say, "So crude oil's going up, what names are you looking at?" And I'd be screaming at the TV, "Why aren't you guys looking at crude oil? Why are you looking at crude oil companies where there could be a CFO scandal that can affect Exxon or affect Valero? Where crude oil is moving, it's crude oil that's moving." So it's where the actual market shows its opinion of the macroeconomic events first.
And sometimes, actually, the futures market is telling you what's going on in the equity markets first as well. How many of you have looked at CNBC or Bloomberg, and in the market's not open yet, and you see something called fair value? And you're wondering, and I've had experienced investors come to me and like, "I don't understand what fair value is." So before we kick it over to Carly, maybe you could just quickly explain to them what it is you're looking at when you turn on your screens, you turn on the news before the equity markets are open, the futures markets are ticking.
It's basically the way that CNBC and others digested it for people who don't trade futures. They look at the futures market, calculate where the cash will open, and they call that fair value. The exact calculation to me is not interesting. But the fact that they're doing it off the futures market to make it discernible for the average equity trader, that's what they're doing.
In other words, futures are telling you what the price is before the equity markets can tell you themselves because they weren't open yet. So Carly, maybe in your seat, you see all kinds of users of futures. I mean, you have a lot of exposure to people who are on the institutional side, a lot of people who are on the retail side. Let's just talk about a couple of the different use cases, and then maybe we can find some trades that are illustrative of these.
Okay. Absolutely. So I talk to retail traders basically for a living. A couple things that I'm going to point out that just to add to some of these guys' conversation. Futures is not for everybody. If somebody tells you trading futures is easy, stop talking to them because it's not. It's very, very difficult. And the first thing that everybody needs to do is make sure they understand exactly what they're trading. And what I mean by that is know what the market hours are, know when it opens and closes, know how to calculate your profit, loss, and risk. That sounds so simple, and most people just let the platform do it for them. But the reality is, if you're going to make quick and efficient decisions at any particular time of the day, you need to have that already in your mind before the platform tells you how much you're making or losing or risking. So make sure you understand. I actually wrote an entire book about just these basics that are super boring. I know you probably think I'm Karen up here, but the reality is most people don't know the basics, and it gets them into trouble later on. One thing I'll mention also is make sure you understand what a stop order is and a limit order. The easiest way to remember what a limit order is an or better order. So if you're trying to buy at a price that's better than the current market price, you're buying on a limit order. If you're trying to buy at a price that's worse than the current market price, it's a stop order. Another thing I'll mention while I'm on the topic is limit orders have to go through it to do it. I get a lot of phone calls from traders that are frustrated because the market hit their price and their order wasn't filled. But the reality is markets aren't perfect. For you to buy or sell a particular product on a limit order, somebody has to be willing to take the other side, and it gets messy, especially in volatile conditions. So you can't force somebody to take the other side of your buy order or your sell order. You just the market has to work naturally, and if no one's willing to do it, you have to live with that. Lastly, I'll say people get scared to trade futures because of the leverage involved. It's scary, but leverage is optional. It's like if you go to the buffet in Vegas, you don't have to have 7 desserts. It's optional. You can have 1. You can do the same thing with futures. If you fully fund your futures account, and what I mean by this is fund your account in the amount of the contract you're trading. So if you're trading in natural gas micro futures, the notional value is roughly $3,000. If you have $3,000 in your account and you buy 1 micro, you're actually not using any leverage at all. If natural gas goes to 0, you've lost $3,000, but that's probably not going to happen. I mean, it might. It's not impossible. But just to give you an idea, you don't have to buy 10 micros in your account just because the margin clerk will allow you to do that. I'm sorry, one more thing. Futures trading is treated differently from a tax perspective. I'm not an accountant, so talk to your accountant about this. But futures contracts are 1256 contracts. At the end of the year, you don't have to report each and every transaction. You only report to the IRS 1 number. You either made money or you lost money, and that's it. So it's very, very simple compared to speculating in stocks. And also, no matter how long you hold a trade, if it's 10 seconds, 10 minutes, or 10 months, you're actually only going to be subject to a 60-40 blend between long-term and short-term capital gain. So assuming you're making money, and that's a big assumption, it's actually tax efficient to trade futures versus stocks.
All right, so one of the things I want to do is make sure this is interactive, and if people have questions, you'll be able to ask them. But I'm going to start with one so we can sort of get the trading side of this kicked off. And I'm just going to ask by show of hands. We're going to look possibly at crude. We could look at index futures. We could look at gold. Any views on, let's start with this. Who wants to see gold first? A good number, okay. Who wants to see index first? I think gold has it. I think that's
Gold it is.
so maybe Adam can pull up a gold contract for us, and maybe Craig can tell us what the specifications for this contract are so that we can understand what the notional value of the contract is, and you understand how much you're going to make or lose for every tick that you're going to see in the futures. So what contract are we going to use, Adam?
So, Michael, we're going to use the micro gold futures contract. And one of the things I want to mention is while Carly was talking, Bobby actually told me on the side here, hey, I want to buy gold here. So we're actually already in a position right now. Currently, we are long 1 micro gold futures contract, which, good call, Bobby, because right now we're up $17 on this specific contract. But I will go through a little bit more of like how we actually got into this contract. And Bobby, I'll probably look to you to figure out when you want to actually exit this contract. But Craig, if you want to go through, we have this widget over here, which is called a snapshot, which gives you a little bit of a summary of what micro gold is trading at right now. It gives you kind of like the bid, the ask, the last traded price. But we also have a tab here for the contract specs. And I'll let Craig go through these from the CME, but it gives you a breakdown of kind of everything that is associated with that particular contract.
Yeah, Craig, if you could just mention all of the gold contracts that are sort of available so that people understand that you have a lot of flexibility. It's not just one instrument.
Right. So, and it's a great point because both Carly and Adam mentioned what we call micro gold. Well, what I think CME's done a good job at over the last several years has been right-sizing futures products for the individual trader. Because if you go back years ago, we only had what we might call standard-sized products, which are bigger. So we've got the micro gold contract up, which is a contract that's worth 10 ounces of gold, which incidentally we're raffling off later today, 3 10-ounce bars. I thought I'd mention that while we're on micro gold. But that size, actually, so the same size that we're raffling off is what the micro gold contract is. So it's a futures contract that's worth 10 ounces of gold, which means that if you buy one micro gold futures contract, you're getting essentially, what are we at, about 3,700, just shy of 3,700? You're getting about $37,000 worth of exposure to the price of gold with one futures contract. Now, if we looked at the bigger contract, what we might call the GC or the standard size gold contract, that's a contract worth 100 ounces of gold, which would be $370,000 worth of gold with one futures contract. So a much bigger contract for a lot of individuals who might not have the risk appetite or the capital to invest that much of their money in gold. So that's the difference when we say like the standard size gold or the micro. And you'll hear us talk about micros, I think, a lot on this stage because, again, I think CME has introduced a lot of these micro-sized contracts that I think right-size futures for a lot of individual traders. The other thing to keep in mind is this is what we call a deliverable contract. And a lot of times I'll be at shows like this or industry shows and things like that, and people come up to the booth and they'll say, I don't want to trade futures because I don't want an oil tanker showing up in my front yard. That's not true, right? No one's going to get an oil tanker in their front yard. But some of these contracts are physically delivered, and you need to be aware of that when you're trading such a contract. And in this case, both the micro gold and the standard size gold contracts are what we call physically delivered, so that if you held that futures contract until it expired, you'd be obligated to either make or take delivery of either 10 or 100 ounces of gold. Now, in reality, I'm sure Robinhood has risk parameters in place where they're not going to let customers go to delivery and a lot of this stuff. But it's something that you want to be aware of if you're trading these products is when that contract expires so that you can get out of it either by selling it if you're long or what we call rolling it into a more deferred month if you want to maintain that exposure. We also have what's called margin in futures. And margin in futures means something very different than it does in stocks. So if you're trading a stock on what we call margin, you essentially you have to put up by Reg T regulations 50% of the notional value of that stock that you're holding. The balance of that 50% would come in the form of a loan from your broker on which you pay interest. When we say margin in futures, I think of it more as a performance bond. So it's an amount of money that we're going to make you put up that basically says, hey, I'm good for this position. And it tends to be a much smaller amount than 50%. So in the case of gold, I'm not sure where we're at. I can't read the margin here. Adam, I'm getting a...
$1,650.
$1,600?
$1,650.
So $1,600 is what you'd have to put up with your firm Robinhood in order to hold $37,000 worth of gold. And that's what we talk about when we say capital efficient, or in other words, leverage. Is that fact, that idea that you can get a lot of exposure for a relatively small amount of money. I think that's, and then the hours, of course. Like most of the CME futures and options contracts, these contracts open at 5 p.m. Chicago time on Sunday night. They're open until 4 p.m. on Friday, Chicago time, with a 1-hour break every day between 4 and 5 Chicago time. So essentially, these products are open around the clock from Sunday evening until Friday afternoon.
Which is really convenient if you have an active futures trader like Bobby who couldn't wait until he got up on the stage to effect a long position in gold, which he did. And I think since they didn't get to walk through it when you did this.
We still can.
Could you please just show them how you came to that conclusion?
So I'm going to have to walk through it. So which one's the 30-minute?
30-minute is
up
on
here?
the left. It's on the left side over there.
That's it.
Your left.
All right. By the way, 2 funny things just happened. Number 1, Craig said Chicago time. I lived in Chicago most of my life. We say Chicago instead of Central. I always found that funny.
Bobby.
Well, no,
also didn't. The other thing I didn't mention was the tick, and I'm sure you're going to get into that.
Yeah, I'll get into that. But we, I live in Florida now, so I say Eastern time or Chicago time. I don't know why we've always done that. So the 30-minute chart actually has a small double top on it, okay? If we get a close, I can't see what that center low is. It's basically right below the digit on the $21. No, this way. I wish I had a pointer.
Right here, Bob?
This one right. You can't see me.
Jump.
Okay. Go to the right. Dude, I'll tear my Achilles if I jump. It's in the very, very recent, let me come over there, because this is actually important.
Which level are you referring
It's
to?
on the 30-minute chart.
Yep.
Right over here.
Oh, this right here?
Yeah, that low.
Okay.
So that gives you a small double top on the 30-minute chart. Okay, so why'd I buy it? The double top is confirmed by the red wick just to the right of it. That confirms the double top in the way that we view double tops. But it didn't trigger it. So what happens a lot of the time with these particular patterns is they pressure to the upside. What are technical patterns? They're just the mob telling you what they're seeing and what they're going to do next, right? Carly is one of the best technical analysts, to me, on the planet. She understands that what's behind her charts is what all you guys are doing. I know guys personally who, when I've gone on CNBC and, you know, they tell, what's the technical showing? And the guy's name is Scott Nations. I love him. He's a great human being. But I remember one time I was looking at a chart and I go, oh, the trends here and the fibs say this. And he goes, oh, that just looks like a lot of lines and squiggles to me. What technical analysis does, and I was in the presentation yesterday where only about half of the people in the keynote stood up that they had ever done any sort of price action or technical analysis. You should learn it because it's really what the mob is doing. When I first started trading, I lost $97,000 inside of 9 months. That was with my first wife. She's not married to me anymore. I'm sure that's part of the reason. But that's because I was right and the market was wrong, which we all know is not true, right? So this particular pattern, if it doesn't trigger the double bottom, it gives me a quick short-term profit on the upside. So it's literally like a 50-50 trade for me.
So if you don't mind me, Bobby, kind of jumping in here, just to kind of show the folks here, you know, essentially where we got in and kind of where our profit and loss is at right now. So when Bobby first came in, he asked me to buy micro gold. I basically went to the ladder here. And, you know, you could obviously place a limit order. You could place a, you know, sell limit, buy limit down here. What I ended up doing was just simply click and buy market. And just like everything else that you trade within Legend, it gives you the same type of order screen where you're then able to simply just choose whether you want market, limit, stop. Obviously, we just went in at the market and bought it. And if you notice on the ladder, you'll see these kind of like, you know, dotted lines down here. That's essentially telling us the price at which we entered into. The other thing, too, is on this ladder up here, it also tells you, hey, we bought one at 36.87 and 30 cents. And then it also tells me, hey, for today, how much am I up or down on this overall position? You can actually see that on the chart, too, which fluctuates, you know, obviously as it's happening in real time. There are ways you could actually remove this from the chart, but I'll leave that there for now. But just kind of wanted to go through a little bit of, hey, this is what we did to actually get into this position. And then, Bobby, I'm curious if you have any thoughts on, you know, where you'd like to limit your risk if you think this goes wrong or where you're looking to actually get out, and we could put some other, you know, limit or stop orders in as well.
So again, that particular level, and I want to make sure that we're highlighting it. Can you widen that out?
Yeah. And if you want, I could actually even put like a little trend line here.
Right below that low?
Right here?
Yeah.
All right.
No, the other one.
This one right here?
The higher low, yeah. Right below that one will be a stop and reverse for me.
Okay, so that would be...
we need to close below it on a 30-minute chart.
So that would be about, what, 36.8240?
Yeah, and we're going to get out of this one quickly. Craig mentioned delivery, and I think one of the things that scares people out of even looking at futures is the possibility of delivery. I trade about 60% futures. It used to be 100% futures. Okay, I grew up in the pits of Chicago. I used to trade 100% futures. My average hold time across my accounts is 26 days. Okay, that includes all my futures. I think I've had to deal with delivery becoming a problem for me as to whether I wanted to deliver or roll into the next contract probably 10 times in 30 years. It doesn't come up that much for active traders. It really doesn't. And when you're with a reputable broker like Robinhood and you're trading futures, they let you know the problem is coming. that you either need to roll or you need to exit or, you know, don't ever do the delivery process.
Bobby,
please.
I was going to ask, just before you got into your exit points, if we could talk about, we're looking at the price of gold priced in dollars and cents, just like you might see it in the cash market. So when it says $38.87 here, that's $38.87 per ounce. Remember I said that this was a 10-ounce product? That means that if the price of gold goes up by $1, that's a $10 impact to your P&L. And this is one of the fundamental differences. I forgot to mention it when I was talking about the contract specs with futures versus stocks, because a lot of people think of the stock market in terms of 100 shares. So if it goes up by $1, it's a $100 move to your P&L. In futures, we have this thing called a multiplier. In this case, that multiplier is 10. So if Bobby makes $1 per ounce on this trade, because it's that 10-ounce micro contract, it's a $10 impact to his P&L. If he were trading the bigger, the GC, 100 ounces, that's a $100 impact to his P&L. I just wanted to make sure that was clear before you got into your exit points and things like that.
I mean, if we buy 1 micro gold, right, future, you're talking about, what, $16.50 you said was the margin right now? The equivalent in like an ETF is about $33,000. Now, even if your Reg T margin, what is that, 50%?
Reg T is going to be 50%.
Okay, you're talking about
when you
$16,000, $17,000 that you have to place down. So it absorbs money that you guys want to use to trade stocks when you're interested in the stock. So it's, to me, that's why, I think that's why Monroe Trout said to me what he said, that real traders trade futures, because you can take advantage of your capital. Now, I have to stress.
Well, with stocks, it's also fully paid. You're borrowing a portion of the capital.
You're borrowing
using margin, so that's an important consideration as well.
I know I'm talking a lot. I apologize for that. I'm Italian. I'm moving my hands. I'm talking a lot. The other thing about it, and we can get out of this if you want.
No, what I was going to say is, if we want, I want to just show them where you're actually looking to, you know.
Yeah, this was a scalp for me, so the target is actually, was about 36.8880, so I would have gone 36.88. It was just a scalp.
So you're looking to either close out at 36.88 here, right? So if for those, you know, that are paying attention, you can go directly to the ladder here. You could simply go over the 36.88. I could put a sell limit in. And then it already has all the details in there that I'm selling at 36.88, and I can just simply just click the sell button. You can see I have an order we're out there working to close it at 36.88. Yeah. But the other thing, too, you mentioned is you're also looking at if, let's say, you are wrong, it doesn't go up to that 36.88 level, that you're looking to actually close out and actually reverse when it gets down to about 36.8240. Is that right?
That's right. And if I were to reverse, that would be a longer-term trade.
Yeah,
so that's where I go from.
And so one of the things I want to mention here is if you're looking at a chart, which we are here right now on the left-hand screen, if you simply just right-click at that 36.8240, I could just simply go in there, click Sell Stop, and it automatically comes up with an order to sell at 36.8240. And if you want to actually reverse it, which is what, you know, Bobby's saying, hey, I might have to do this, you could actually change this and change the quantity to 2, which then you would simply click Sell, and now I have an order to sell 2 at that point, which would essentially reverse my position at that level.
So what I'm trying to do is take advantage of the double top. You can see in the middle of your chart on the screen there, the double bottom that worked out really well on that same chart to the left of that. Right, you can see the 2 bottoms. Looks like they were on about September 9th. Yeah, both of them were on about September 9th. You could see a double bottom there. Double tops and double bottoms are reversal patterns.
And one other thing I want to mention here is, you know, we obviously keep talking about, hey, you don't want to take expiration of the product. If you go and pull up a widget in Legend, and specifically it's called a snapshot widget, it has the contract specs in here. We try to make it as easy for you to understand when you need to close these positions out. So if you go to this LDTT, that stands for last day to trade, that's actually telling you, hey, this is the last day for you to actually close your position. If you don't do it by then you're going to get some emails from us, and then eventually what will happen is we'll liquidate the position because we obviously don't allow anyone to take physical delivery. But also, if you're just looking at a positions widget over here, you can see right now we're long 1 of the micro gold. Has that same column there for LDT, or last day to trade. Again, it tells you, hey, this is the last day you have to actually close this position or hold it.
Everybody feeling like you're kind of getting the concept? What's going on? Do we have a microphone for her? Otherwise, I'll come over and have a listen so I can.
I can hear.
Are you an opera singer so you can really get up there and project? Sure, go ahead.
Yeah. So for those that couldn't hear, I believe the question was, is what are the commissions on futures for these contracts? Is that correct? All right. So we try to simplify it for everybody here. If you are a gold member of Robinhood, the commission is 50 cents per contract plus exchange fees. And then if you don't have gold, then the commission is 75 cents per contract plus exchange fees. And that's applicable to every single contract that we offer.
75 cents a contract to trade $37,000 worth of gold. I think we should try to do a trade in another product.
I agree.
And I'd like to hear from Carly. Now, one of the things I want to say, because some of you may not be familiar with these, with the price ladders that you see here when you look at a futures market. This is old hat for everybody who's been in the futures market, but it kind of speaks to the supply and demand and pricing dynamics that are a reality of every asset, every instrument that you trade. One of the reasons that I think being able to see that and being able to see technical indicators is so important is that if you know nothing else about something, that can tell you a lot. Just like you go to some city, you've never been there, you're looking for a place to eat, you walk down the street, half the restaurants are empty, some have nobody in them, and one's got a line around the block. Next night, you come back, same thing. I think we've already figured out where the food is good. The crowd's telling you. Carly, you're the technical expert here. Why don't you walk us through all of this?
Okay. So first I'm just going to add to what Bob has explained here. I wanted to just explain the price ladder a little more. For us, it seems obvious, but I think for a lot of people that are new to this, it might not be. The ladder is telling you where limit orders are working. It doesn't include stop orders, and it doesn't include market orders. So a lot of beginning traders think that they can look at a ladder, and I mean, maybe they can. Maybe they have some skill that I don't have. But they assume if you can see there's a big sell order in gold at 36.87, they think if it hits that price, it's obviously going to come down because all these people are selling at that price. But that's really just not how it works, because this is only telling us a third of the picture. It's not including market orders. It's not including stop orders. Another thing I'll point out is we've already talked about the leverage for $1,650. You can basically make or lose money based on $37,000 worth of gold. And that sounds great as long as you're on the wrong side. If you're on if you're on the right side, it's great. If you're on the wrong side, it's kind of merciless. So just keep that in mind. The margin requirement, correct me if I'm wrong, Craig, it's my belief that the exchange sets margin requirements basically at what they believe is there's no such thing as a worst case scenario, because worst case can become even worse than you would ever imagine. But I think they set it to basically what they think might be the worst case scenario for a single trading session. So if you're going long or short gold, just keep that in mind. The exchange is buffering their risk. Their good faith deposit is basically telling you you might lose $1,650 if you don't place a stop order or manage your risk if something out of the ordinary happens. Most days we're never going to see that type of move, but it can happen. You want to take a look at crude oil?
Yeah, let's take a look at crude.
Okay.
Which crude contract are you bringing up, Adam?
Yeah, so I'm bringing up the micro crude oil contract. And by the way, you could see that whenever I click on this futures watch list that we have here, when I click on the preset symbols which we have, which is MCL or /MCL for micro crude oil, it automatically switches all my widgets here to just solely look at micro crude oil. So something that you guys have noticed is everything here in the upper left-hand corner is blue. That means it links all these together. So anytime I switch a symbol, it automatically brings everything up.
Okay, so can you please pull up a 360-minute chart? It's basically a 6-hour chart. I am not a day trader. Please don't. I'm not an expert in day trading. But what I do generally is I get my big picture analysis. I'm using seasonals. I'm using the COT report, which is a report the government issues that tells us who's long and who's short and by how much. I'm looking at monthly charts and weekly charts, and then I get a bias. And that bias might persist for years. I've been basically bearish crude oil for 3 years now. And so with that in mind, I go to a 6-hour chart and I look for possible entry points. And I'm looking for, can you put Bollinger Bands?
Bollinger Bands?
And
sure.
RSI. This is just a very, very simple, and again, these are ideas. No, I'm not giving you advice. What works for me might not work for you because everybody's personality is different. You want to pick a strategy that obviously works more than it doesn't, but more importantly is something that doesn't stress you out, because if you're trading someone else's strategy, or you're over trading, you're maybe too leveraged and you're stressing yourself out, I promise it's not going to end well for you. The name of this game is to find something you're comfortable with and go with it, but less is more. So, okay, so you can see in crude oil, my bias is to the downside. Anytime that we rally, I consider, don't always do anything about it, but I consider possibly shorting it, depending on what the circumstances are. Obviously, I pay attention to fundamentals as well. But you can kind of draw a trend line from the highs up there.
The high
it's a little bit messy. Yeah, just draw a basic trend line. I'm not as smart as Bob. I'm very, very simple. It's really just two indicators, Bollinger Bands, RSI, a trend line. And the idea is if RSI gets overbought, and by the way, I'm a contrarian. Sometimes that gets me into trouble. So risk management's important. But this is what I'm comfortable doing. If I'm bullish crude oil, I will never, if I'm bearish crude oil, you will never see me buying it. Because what do? I do dumb things. I stress out. It doesn't work for me. So I will always be a seller until my bias changes. And you can see every time RSI gets above 70, pokes above that blue channel, and prices extend over the Bollinger Band, it's not going to happen every time, but on a 6-hour chart, most of the time, that's a pretty good sell. And as far as placing stop orders, I talk to retail traders a lot that think their mindset is they want to place tight stops because they want to manage their risk to something very minimal. On paper, that sounds good. But the reality is that what happens is they lose 10, 12, 13 trades in a row. They only lost $50, $100, but that adds up pretty quickly, right? So what I would suggest, I'm not a fan of stops, but I think beginning traders probably should have stops. So what I would suggest is just consider putting your stop somewhere as a catastrophic stop. Maybe use the margin requirement as your catastrophic stop. So if the crude oil margin is $1,000 for a micro, place a $10 stop. I know that sounds crazy, but the reality is you're probably not going to get stopped out unless you're just really, really wrong. Whereas if you have a tight stop, you're going to get stopped out even if you're not wrong. You might be right and still get stopped out.
So your thinking on this stop basically is consistent with your longer, broader thesis.
Right.
So for those, I think this is a really interesting thing to think about, that you can have an overarching sort of fundamental view about the instrument involved and then trade opportunistically around that thesis, right?
Correct, right. So again, the idea is you can get, if you happen to get all three of these things that line up, the RSI, the Bollinger Bands, and the trend line, you might even get a little more aggressive with it. Maybe 2 micros, don't get crazy. But yeah, super simple, works more than it doesn't. That's the goal, right?
So we have a way to get in. We have a stop area to get out. What are you looking for to the downside where you might cover that position? So
to clarify, catastrophic stop to start. But if, let's say that things start going your way, go to a break-even stop. That way, you are actively managing your risk and not just being complacent. Because complacency is going to kill you in this business, I promise. I've done it, I've seen it, I've lived it. Don't do that. If it goes your way, go to a break-even stop and then play it out from there. As far as the downside targets, I usually will go to probably a daily chart, but I'll tell you a secret. You can use the 6-hour chart, and you want to look, I look for Bollinger Band extremes. If you can see right there on the far right, you see that extreme where the Bollinger Band pops down and we get oversold. There you go. I'd probably use that area right there. I can't see it. I think it's 61. So I'd probably be looking to sell 64 or buy 61 if I was swing trading. Most of our trades are much longer term. We would use this entry as a pinpoint entry, but we'd be looking at a daily chart. And to be fair, our exit's probably in the mid to low 50s on a swing trade.
So if she does make the $3, Craig, how much has she made on this contract?
Right, so very similar to gold, our crude oil products also have a micro and a standard size version. So the standard size version is worth 1,000 barrels of crude. The micro is worth 100 barrels of crude, so very similar to gold in terms of that 10-to-1 ratio. So a $3 move then at 100 barrels would be $300 impact to the P&L. The other thing I want to mention too, just kind of at a higher level, Adam, am I right in presuming that if we pulled up an equity ladder, it would appear to look very much the same way? Like the numbers are different and stuff like that, but it looks very similar, right? My point is that, and Carly's mentioned this, market, stop, limit, the ladder, bids and offers, they all work very much the same way that you're used to in the equity world in terms of like that execution mechanics. So I want to point that out because even that I think kind of trips people up on futures is that in terms of executing the trade, it looks very much the same as you would see in an options or an equity trade.
Yeah, and let me go back real quick to micro crude oil because I want to actually put these positions on that Carly was just mentioning. So Carly, if I'm not mistaken, if I heard you correctly, you're looking to go short right here in micro crude oil, is that correct?
Correct, yes.
Okay, so again, you could do this through a multitude of different ways throughout Legend. I'm just going to go ahead and just click sell up here on the chart, and we're just going to enter in through a market order, and I'll just go ahead and do that, and you can see right there we just got filled. We're now short at 63.74. And then, Carl, you said you're looking to minimize your risk about 10 points below. Is that correct?
Place a stop about 10 points above. That's representative of the margin requirement.
Yeah, I'm sorry, you're right.
Yeah.
10 points above, right? Because we went short, so we have to put a buy stop in about 10 points above.
And again, I know some people think I'm insane for doing that because why would you risk $10 on a crude oil trade? But the reality is it's probably not going to rally there. And if it does, you're out $1,000. But if you place a tight stop and get stopped out 10 times, trying to catch a $300 move, the math isn't going to work out.
Yeah, so again, you can see here, we're just clicking on the chart. I'm pulling up an order ticket and just simply entering in my stop price at 73.74. And you can see it just automatically just places that stop order there. The nice thing, it also shows that in the ladder, and something that I want to mention, which is hopefully going to be helpful to everyone, is you can see right now on the ladder, we have everything kind of navigating through specific prices. If you click on the P&L down here, it actually changes the ladder to show you, as the prices move up or down, what's my overall P&L. And if you go to this particular stop and you click on it, you can see we're basically, putting a stop order in to minimize our losses to just $1,000 total. And that's obviously what Carly mentioned there. But this is another area where kind of what Craig mentioned is there's different tick sizes, there's different tick values for every different type of futures contract. And so we try to simplify it down so people can, don't have to necessarily do the math to figure out like, hey, if it goes up or down this many points, what's my P&L going to look like? So all you have to do on the ladder is once you're in a position, click on P&L. It'll switch everything to show you where your specific profit and loss is going to be at.
This morning we got some pretty interesting macroeconomic news. PPI came in light. Obviously, this is a situation where it improves the likelihood that we get a rate cut. You would normally think of that as being bullish for equities, bullish for gold. Obviously, crude has been in a bit of a downtrend. One could argue that economically that's indicative that there's some issues there. So on the demand side, why don't we take a look at some equities and pull up an index future, if we could. What would you like to take a look at, Bobby?
Let's do the micro S&P.
Sounds good. Yeah, we're going to pull up the /MES contract, which is the micro S&P 500. And it represents basically $5 times the price of the index. So you can see that here in the contract specs. Each point is going to be worth $5.
So I'm so dim, I didn't know we had the charts here. I actually got up and pointed over there, so now I'm looking at them in the right place. First of all, I want to say that, so the woman over here was kind enough to ask a question. I hope we get more of them. I don't consider myself a day trader. I don't consider myself a scalper. As I mentioned, my average hold time is 26 days, which a lot of people would call me a swing trader. I hate all of those terms. I have held futures trades for 6 minutes. I've held them for 6 months. It all just, to me, depends on stop, target, and the risk. One of the great things about these micro contracts is I was talking to Craig earlier this morning. I was talking about the difference of buying 10 micro gold versus buying, Barrick gold or even GLD. And he said, well, why are you buying 10 micros instead of one big one? And I said, well, because I want to be able to get out one contract at a time, right? And I'll be able to scale in, scale out, and that kind of a thing. When I look at this S&P, and I use a derivative of Bollinger Bands. Everything's basically a derivative of Bollinger. What a smart guy. I use something called percentage B, and I'm waiting on a percentage B on a shorter term chart to give me a buy signal, and I haven't gotten one yet. You mentioned stocks. This is one of the things I enjoy about futures, is because of the micros, I can shrink my positions down so small. I owned Chewy, and yesterday I was in profit. And this morning, I woke up, and I wasn't anymore, right, because of the earnings. So we talk a lot about risk with the macro picture. Macro for stocks is obviously earnings for the most part, right? Macro for the S&P is back to the economic news. So I got hurt on Chewy while the S&P was positive and still is. So I personally prefer to put the vast majority of the trades I think are going to be shorter term into the larger indices on the future side, so that I don't have to put up so much money up in the Qs or the SPY or anything else you guys want to trade. So for this particular contract, I keep waiting for a short signal, and I'm not getting it because of what Carly said. The larger picture for me in equities is to the long side. So I don't have a micro S&P trade to show you guys. But what I will say is that if you're looking for shorter term trades, the micro S&P and the micro NASDAQ, where I might actually have a trade, should have said that first, is probably a better look. When you look at the volatility involved in these, over these economic events like PPI, like CPI, we keep waiting for that tariff inflation. We keep hearing about that tariff inflation that's going to come down the pike. Mike Lee, who's a pretty smart guy, he posted on X this morning, maybe next month we'll get that tariff inflation. But right now, with the structure of the macroeconomics that we're looking at a Fed that's either going to ease a little or ease a lot, depending on what the macro data shows. And the S&P, I think, is the best place where that's going to play out. We have a really strong breakout level. You can kind of see it. I don't even need to show you where it is on this chart. The S&P broke out and now is going back, trying to test that larger breakout level. That's where I'd like to, right about there. That's where I'd like to buy it if we get down there. I don't know if we'll get down there during this session.
So, Bob, you're talking right around
what price is that?
65.20?
Yeah, about 65.20.
So again, guys, for everyone here, it's pretty easy. If this is where we're looking at to potentially buy, you could just simply right-click on the chart if you're looking at it, click Buy Limit, and then I could just go ahead and just enter the order, and you can see it just places it there. So when it does get down to that 65.20 half level, we'll end up buying one of those contracts.
Is that a crazy buy, Carly, or no? You could tell me. I don't care.
I'd be a seller, but I mean, it's not crazy, no. And I'll tell you why I would sell it. If you look at the RSI on the 6-hour chart, it's consistently making lower highs, and that usually is a sign of dysfunction to the rally. It doesn't always work this way, but I'd be a seller. Also, if you look at a monthly chart, we're right up against resistance. Seasonality is a little questionable this time of year.
Yeah.
I'm not expecting Armageddon, but I'd prefer to be short here. Oh,
I think we had a question out here.
Throw the mic. Yeah.
There's a
yeah.
I'm hearing there's a mic out there.
The microphone right there, that'd be great.
Yes, I wanted to ask about scale in, scale out. I do the same thing, but as far as the average goes with the dotted lines, it seems like it's FIFO in terms of the order flow. So if you could customize it if you want to get in at a certain time, and then, like you said, wait it out, because I'll play September, I'll play December, but I do the same approach where I might have some further long, but then the average is affected about when you bought it.
That's correct. So when it comes to futures trading, we use the FIFO accounting method. So everything you see within Legend or on mobile, it's always going to look at first in, first out when you look at where your average position is going to be at overall.
Right, but if you wanted to use one of the ones that you had in a lower cost, would you have to technically get a broker assist on that? Or?
No, unfortunately, that's not possible.
Okay.
Yeah, everything that we do with futures, it's all FIFO, and there's no way to change that whatsoever.
Okay.
Scaling in for me was something I started doing because of my FOMO. Like I would see a trade, but I would know I needed to buy it lower. So then I would get in early, and then I'd be mad because I put on my full risk. So scaling in was something that allowed me to get into trades. And then it's like, all right, I wish I put on the full amount, but I didn't. That's okay. I still made something.
And I was mainly looking, not necessarily get it at a lower price, but then with the tax loss, with the harvesting. Yeah. That's why I was looking for that.
Yeah, well, one thing to mention on that regarding taxes and accounting for futures, the one thing is these futures are mark to market every day. So regardless of whether or not you're removing one specific contract at an earlier date or one at a later date, no matter what, at the end of the day, these contracts, as Carly mentioned earlier, they're 1256 contracts, which means they're marked to market every day. So regardless, you're going to have a realized P&L no matter what way you choose. So it's always going to be referencing, what your P&L is for that particular day. And even if you close out one earlier, it's still going to reflect like the same P&L essentially overall.
He did.
So it's tax.
When you close the trade, of course.
Correct.
Right. Okay.
Actually, your tax consequences really don't kick in until December 31st. Honestly, you can do anything you want from January to December, but that's what matters is how much your account is worth on December 31st plus or minus what you put in and took out. It's really that easy.
Carly, on the holding period thing, we know what Bobby's average holding period is, and we were talking about scaling in, fear of missing out, so it's starting to come your way, getting into it in small pieces. How often do you or the people you're working with scale into positions that are actually working your way?
Always. Okay, so we're not usually like, if we go long and it's going in our favor, we very rarely will add into strength. So that's just not, again, that's not my personality. It might not be the right way to play, but that's how I'm comfortable doing it. But one thing I think we should also point out is the futures markets were created for hedging. So I know all of us are speculating, but they're actually hedging vehicles. So you can, if you go short a micro S&P, you're basically hedging roughly $33,000 worth of S&P 500 stock, and you're not creating a taxable event. So if you're somebody that's holding on to SPY, SPX, and you're making some money, but you don't want a tax consequence, you can sell a micro future. You lock in your price, you still earn dividends, but you have no price risk. So keep in mind, you can use it for hedging as well.
An important use case. Do we have, go ahead.
Hi, me again. So how do you handle when the contract expires and you roll to the next contract?
Question.
So, so the question, how do you know when to roll your contract or when it goes through? So on the platform here, again, there's this contract specs page under the widget for Snapshot, which tells you the last day to trade, which here is telling you, hey, last day to trade is September 19, 2025. One thing that's important that you really need to pay attention to for each future is whether or not it's a cash-settled future or whether it's a physically settled future. So this is a cash-settled future, meaning that at expiration, what's going to happen is this contract will settle to cash. So essentially, your account will receive a debit or credit overall, depending on whether you're up or down. And for this specific one, we actually allow customers to go all the way through delivery for cash-settled products because it's just simple, just cash, credit, or debit. However, for physically settled futures contracts like micro gold that we looked at earlier, those we require people to actually you have to get out because we don't actually allow people to take physical delivery. And so again, you look at this last day to trade, that's telling you, hey, this is the last day on which you can actually close your position. And one thing that we'll do is we'll send you emails. So if you're in a position and sometimes you may forget about the day, you may just, it may just slip your mind, we'll be actively sending you emails and push notifications to let you know, hey, this contract is expiring soon as an FYI. Like if you want, you could take a look at the next expiration. So over here, we have these different symbols, and you can see it's kind of grayed out to the right of it, which is telling you, hey, this is the month that you're trading. What you'll see is when the months actually switch to the next active contract, you'll see these also switch on here as well. And again, it's something that we'll send some emails to you to let you know when you're in these positions that, hey, you might want to close or roll your position. You have until this day. And so that's something that we try to help
So there's not like a continuous
I think
futures
we've got
contract?
another question over here. Let's just try to grab these last two. I'm not sure how much time we have, but I think we're running out. Why don't we start right here on the left? Oh, he was here first. Thank you for keeping track of who's in line. Go ahead.
Thank you. So a question I have was about further out month contracts versus current month contract. Are there advantages of purchasing further out month contracts if you wanted to, let's say, hold it for longer? I know some of you mentioned holding it for months. So does that give an advantage since you don't have to roll your contracts?
Personally, I would always roll rather than do that. The further out month contracts, crude oil is the thing I trade more than anything, right? And the further out contracts, specifically in crude oil, can sometimes give you a hint on how your near-term trade is going to do in the future. But I personally roll because the further out contracts are much more often hedging vehicles, and they don't have the liquidity, at least in my experience.
Yeah, so I mean, I would like to just jump in on this one really quickly. When I was trading nat gas on the NYMEX, an important consideration also if you go further out on the futures curve is that those instruments may not trade the way spot does. They may not trade at all the way spot does, because there are very specific supply and demand dynamics that exist in marketplaces. So for example, if you're dealing with natural gas, we have what we call the injection season. It's when we're producing excess natural gas and it's going into storage. And then we have the withdrawal season, the periods of time when demand for natural gas exceeds how much is actually being produced at any moment. And those shoulder months when you have the tail end of the injection season or the tail end of the withdrawal season can get really wild supply-demand imbalance dynamics going on. And what you will see if you look at the futures curve, that they're not necessarily going to be in a consistent line. If you look at gold, much like the index futures, is going to have a fairly consistent rate-based curve. So just basically, can you show a futures curve so we can illustrate this?
That's not available at the moment.
Okay, well, that is, I'm sure, on the very short list of things that they're going to be doing. But yeah, you will be able to see this anyway, because all you need to do is take a look at one expiration and then the next and then the next, and you're going to see that that's the case. So some things you can do that, and you can trade a long-dated future. But in other cases, the specific dynamics of that expiration can be different than the ones that are near-dated. So I would keep an eye on that. Thank you.
Hello, I'm curious about margin requirements. And for example, let's say I didn't take the good advice to set up a stop loss, and my trade went against me, and I decided to diamond hand through everything. I'm curious, is there any mechanism or ways for me to keep track of margin requirements before I get margin called, or how I can avoid that?
So if I'm hearing this correctly, you're saying the question was how can you monitor your margin requirements for your positions? So one of the things here is in the position widget here specifically, I could actually add a column in here for, where is it at here? It's down here somewhere. Oh, sorry, no, I'm sorry. My apologies. It's actually on the watch list. I apologize. So on the watch list, you could actually have a column here specifically for initial margin. And you can see here you have these positions that show up where it has your MGC, your MCL, your positions. It tells you what your overall margin requirement is on these two contracts. The other thing, too, is I don't have a widget. I'll add a account summary here just to kind of show you that all of your information regarding your entire account can be found here, which includes your futures buying power. And it'll also tell you what your P&L is for the day, what your margin requirements are. So you have this futures margin held section down here. And this will tell you, hey, overall in my account, this is how much buying power is basically being reduced for my futures positions. Now, it includes your positions and any working orders. So if you noticed earlier, right now, we have these orders working for micro gold, and there's a few that would actually reverse our position, which is why you see a little bit higher requirement there. If I was to cancel all of my working orders that I have out here, which I'll do real quick, you'll see that your margin requirement is going to decrease. So now, just in my positions alone, I have a margin requirement of about $2,614. So it's in there. It's in the account summary. And then if you want to look at it beforehand, there's the snapshot widget, and there's also this initial margin requirement here. And one thing I want to mention before we break is I will be doing a more in-depth demo on Legend where you can see some more of this literally right after this. So if you want to go over to the booth, I can walk you through any questions or anything you guys may have in regards to Legend, how it works.
Adam, if our time has expired, I'm wondering whether Bobby's gold trade has. What are we going to do here before we break? Are you going to stay in this one?
Well, we got out of it, didn't we?
Let's see here. Where are we at? We're currently down $28, Bobby. What do we do?
I thought we hit my target, but I could be wrong.
I think we hit it before we were able to talk about it, so I think you were right in hindsight, but by the time we got to talk about it,
I'm right every day in hindsight. Yeah, you can just take it.
I think what we're going to do here is we'll probably close it out because I think we're ending here. So again, if you guys want, there's this little button up here where you can, it's basically, we call it the get out button, just get me out. And you could actually click on this little button here, and what it does is it closes your positions and it cancels all your working orders. And you do that, what it does, it sends a market order, closes your position. I already canceled my working orders to show that, but you can see I'm out now. And I can see I was filled at 36.8460 to close that position. So we lost $27 on that trade.
Are we still in the crude contract? Are we still in crude?
We are still in crude right now. You can see our position is currently down $2 as we speak.
Not even a cup of coffee.
Yeah. We'll close that one out because we're done here. But yeah, again, you could close it out a multitude of ways, like anything you see. I'm going to click this X here to pull up an order just to simply close it out. And we'll close that out. We ended up losing a total of $4 on that trade as well.
All right. Well, thank you all very much for your time and attention. I learned a lot from this esteemed panel here today, and I love the demo from Adam, so thank you very much. Head on over to the booth if you want to see some more of this in action.
We'll now be breaking for lunch until 1:30 p.m. Head to Primrose Hall or the event lawn to fuel up for the rest of the day.